You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver, Jem Kazan, Mark Resemczynski, Alan Dunn, and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Now, today and next week will be very special episodes because we get together as a group, even if Rich is unable to join us today, for one big conversation and debate of topics we believe have been important during the year. Plus, we have a topic that was brought to us by one of our listeners that I thought was very relevant. As you know, the podcast series is all about voicing our differences on the one topic that brings us together, namely systematic investing. So we hope that you will enjoy this group conversation over the next 2 weeks. We're recording today on December 6th, and this conversation will be split into 2 parts and published on December 24th and December 31st. And therefore, there will be no market wrap or performance updates. We have a long list of great topics, and we'll be discussing those. But before we kick off with the first topic, maybe I could just sort of, like we did last year, Jim was not here, but like we did last year, some of you had made some special preparations for the conversation. I remember Rob was, you had warmed up well with some Christmas themes. I know people can't see us, but maybe, Rob, you can just sort of highlight a little bit how your preparations have been for this year's debate.
Well, last year, actually, I had boxing gloves with me because our good friend, a good American friend, was on the podcast, so I knew there'd be some harsh debates, but things are probably a bit more gentlemanly today. So I haven't got boxing gloves with me, but I'm wearing my traditional Christmas jumper, so I'm ready to go. Yeah,
and I admittedly, I think you are the one that is most Christmassy today, so why don't we just dive straight into it. Now, as I said, the first thing I wanted to bring up was really a topic that was brought to us by Zach. And I think we can all agree that 2022 did not pan out the way many experts predicted. And it would go down as a year where we used the word unprecedented quite a few times. And also, as we kind of talked about in 2021 and 2022, it has been kind of the end of an era maybe where central banks were fully in control for the prior 2 decades. So Zach kicks off with a question that is written like this. I recently finished reading The Rise of Carry, which, by the way, is co-written by one of our co-hosts, namely Kevin Coldiron, who hosts the Ideas Lab series. And Zach continues. Your request for topics for the year and for the year-end roundtable discussion and the book got me thinking about this question. Have we seen an end to the carry regime that has dominated the past 12 to 14 years? What is the indicator that this carry regime has ended? Could the indicator be the performance results of divergent strategies? ? Have a good week. I'm looking forward to the conversation. So I'm going to just go throw out to you, Mark, first maybe, and just think, so your thoughts about this stable carry regime that we have defined. I don't know if you believe it's ended or not, but what would you be looking for, whether to tell if it's ended or not?
Well, I think it's just a matter of whether we're in transition. So looking at carry trades for a long time in the FX area and then looking at different types of carries, let's say backwardation, contango type trades in commodities, you find that there are periods of regime transition, and that's what we may be in when you have higher volatility. What you really look for carry, or at least I look for carry, is a dispersion in returns. And so as long as you can get dispersion in returns and differences in central bank behavior, then you can create opportunities in carry. Specifically, we'll sort of say that when there's high volatility or spikes in volatility, then you have to exit from carry. Those may last for months, could be quarters, but eventually they subside, and then opportunities then arise again in the carry space.
Jim, I also want to ask you, you come obviously with a different perspective to the rest of us, and this is a topic that I think you and I have kind of touched on quite a few times during the Global Macro series. To you, this definition, however we define it, carry regime, I define it as just this very stable environment where central banks were fully in control. But what does it look like to you? Do you think that it has ended? And what is the kind of the indicator for you that tells you that this may have ended?
Well, to me, the biggest carry trade in the market always is upside versus downside in the market, right? Skew. In the volatility markets that I trade in, there's usually an equity skew, a massive left tail skew. And the reason that is because the whole world is long. You have $400 trillion of long assets, and people hedge that tail, which creates a supply and demand imbalance, which is the defining characteristic of all carry trades, and a fat left tail with a positive bias. That has been exacerbated by massive positive flows into investment from 0% interest rates. It's that simple. That's caused more leverage to the trade and a fatter left tail, but with a strong positive bias for some time now. I do believe that regime is, for the time being, for the next decade, slowing. It's not something that goes away. There's always that carry trade, but it's a function of less leverage in the system. A rebalancing and a deleveraging, which removes some of that positive bias that we're seeing. The cost of money is going up, and ironically, this is counterintuitive to most, but should reduce the fat tail over time here. So I think markets are likely to have a deleveraging process, which eventually flattens, over this period, the downside and creates a put on the market with lower valuations and better cash flows. But in the time being, we've seen that this year. That's been one of the defining characteristics of this year, which is a flattening skew. And I think that's actually somewhat efficient in the medium to longer term, even though most people are out there kind of running around saying, this is crazy, this is the 0th percentile, this is unsustainable. So, but we can get to that later.
Sure. Rob, what are your thoughts?
Yeah, I mean, I'm a little bit in disagreement. So if I look at the empirical evidence I've got, which is for the carry strategy I use, which is across a lot of different futures, different asset classes and futures. So it doesn't cover spot FX. It doesn't cover options on, non-linear stuff. So it's purely in futures, but it is across asset classes. So it's it's moving away slightly from the very poor carry stories in certain parts of the space. So it's true to say that over the last kind of 18 months, 2 years, really since COVID, carry hasn't done very well at all. But that's not unprecedented. So carry did very badly, as you might expect, in 2008, 2009. It did very badly in 1999 because those are obviously periods of, bluntly, the shit hitting the fan, which is what carry doesn't like. But if I look back even further to the late 1970s, which is kind of towards the start of my data, is actually the really horribly horrific period for carry then, much worse than what we're seeing now. And then after that, carry went on a, sort of 25, 30-year bull run. So, but based purely on empirical evidence, if this is some kind of statistical distribution that whose parameters I'm trying to estimate, I wouldn't say that there's been enough evidence in the last 18 months to say, we should just stop trading carry because it's not going to work now. That's not the case. And there's one other point I'd like to make as well, which is around this kind of very common story that carry does really badly when volatility is high. And actually, I found that that's true to an extent, but interestingly, momentum does even worse, at least based on the measure of volatility that I've been using, which is kind of on a market by market basis. And so actually, on a relative basis, when things are really going crazy, carry seems to do relatively well compared to, say, momentum, which is kind of the other main tool in my particular bag, which may surprise some people. But again, for me, it's not necessarily a clear evidence that, at least the way I trade carry, I should be turning the thing off. I'm pretty happy to let it run with the current allocation.
I think, in fairness, Rob, also that when I read the book, The Carry Regime, and when we first actually had Kevin on as a guest before he became a co-host, my impression was not necessarily that they defined it as, does carry strategies work? It was also like, during that, what they define as the carry regime, say from year 2000 up until end of 2019, what investors would have done really well from was just being long stocks and bonds, ideally bonds with leverage, and that worked perfectly. And so I don't necessarily mean that carry strategies have stopped working, although it is interesting that you say that they worked really well, worked poorly at some point in the 70s and then went on this massive run. But of course, that ties in well with kind of globalization and how everything became more stable in that sense. But of course, some carry strategies will probably always continue to work to some extent. Anything else you want to add to this? Yeah, Jim?
Yeah, I'll dive in. I actually agree that I don't think carry's dead or going away. I think carry's always a source of real edge in the sense that it's a supply-demand imbalance that's structurally in the market at all times. I think the argument here, for me at least, is that it's we're experiencing a deleveraging. In periods like '08, those deleveragings are fast and they end quickly, and the carry trade comes back quickly. Periods like the '70s, where they're inflationary, where the cost of money is going up secularly, those deleveragings are long and they're slower, and they can lead to headwinds for extended periods of time. And it hurts. It's a headwind for carry trades because the supply and demand imbalances are a bit more balanced during those periods. So I think that would be my argument. I think it's always carry trades, again, represent the $400 trillion, like I said. You can't hedge that. That creates a carry trade. That's not going away. It's just the headwinds that make that a bit more balanced. Those types of carry trades a bit more, balanced during these periods.
Yeah, I mean, I think what maybe we're getting at is that there is a sense of a regime shift underway. It's just whether you call it the end of carry, whether that's the right characterization for it. I mean, there's a lot of kind of patterns, trends that have been in place for at least 2 decades, maybe 4 decades, in terms of declining interest rates, falling inflation rates, globalization, etc., that appear to be about to shift now. Other characterizations of this, we had Isabel Schnabel talking about the great volatility, whereas previously we had the great moderation. So I think there is a sense from a macro perspective that we may be in the midst of a regime shift, but at the same time, is calling it the end of carry the right characterization? As you guys have said, there's always carry opportunities. We've had a great carry opportunity in dollar yen this year. If commodity markets get very backwardated, you could have great carry opportunities there. So we talked about a McKinsey paper going back a few weeks. They talked about this issue, and they just called it a new era. They didn't put a name on it. So I think the name is up for grabs. But from a macro perspective, I think lots of macro trends have reversed this year, and you can make a good case for why we are in a new regime or a new era.
Yeah, I mean, tying this back to what you're saying, Niels, I think the regime change perhaps is that easy money over the last 10 years has been going long financial assets because of carry benefits. But of course, a carry strategy can go short, and it can also trade commodities and other asset classes. And, so that's where I think there are still opportunities. It's just unlikely that you're just going to make a heck of a lot of money just from, doing a typical bond carry strategy or a typical FX carry strategy. We're just going long everything.
Right. And that's the real distinction, I think. It's not so much that it's a change in carry strategies that we're seeing, is that traders will adjust to the environment on their strategies. It's the leverage that's the issue. So the idea that you had cheap leverage that you could then borrow money and then buy assets and hold them for long periods of time is the end of the era. Now you're going to have to actually work for your money as opposed to just borrowing a little, money, leveraging up and just holding assets. So we'll sort of say before or in the previous era, you could just sort of like hold and not have to work. And now you're going to have to work for your money.
Yeah, well, absolutely. I think we all know that. All right, let's jump on to the first topic that we brought along, so to speak, and it's from Alan. And I thought maybe today what we can do is that I'll just give sort of the highlight, and then the person who brought along the topic can say a few words about it, set some context. But Alan, the first topic I chose of yours to talk about is, and maybe there's a theme in this conversation today, focusing more on the year 2022, and then next week we will focus on maybe looking a little bit more into the future. But you raised the question about why was 2022 such a strong year for trend followers, and were there any particular sort of holding periods that worked better than others? So do you want to set a little bit of context? And I don't know, Jim, if you want to weigh in on this particular topic, but you can always do that, of course.
Yeah, sure. I guess this is kind of an end of year review, and typically when as somebody involved with managing, multi-manager portfolios, when you went out to speak to clients, these are the kind of questions that you got in these kind of year-end review forums. And obviously we've seen an exceptionally strong year for trend following. So I think that will raise two questions. One, there's the mechanical, what did well, what did badly this year, which I guess some of their guys will probably have more to comment on. My sense is probably across lots of different timeframes, it's been pretty good year this year, as opposed to, and where in some years you get a big dispersion depending on whether you're commodity focused or not, or whether you're more financially focused. I think we've had trends across many markets. But I think there is a second question that people will ask. It's been such a good year for trend following. Was there something very unique about the year this year that led to that? And was it more of a one-off? This will be the argument that you would get. So I think the simple answer to the question is obviously we saw strong trends in markets. Obviously trend following does well when you get persistent price action. Secondly, it was across a number of different markets. Sometimes you'll get a strong trend in one market sector, but fairly choppy action across the other sectors. But certainly bonds, interest rates, commodities, all did well this year. Equities a bit choppier. And I think a third issue I wanted to just touch on was in some markets you did have very favorable setups, particularly in interest rates and bonds. You had a very strong volatility expansion. So if you went back to the start of the year in bonds and short-term interest rates, or into kind of the latter part of last year, volatility was low. So if you were getting signals to go short in those markets, you were putting those positions on in very meaningful size. So that combination of strong directional momentum plus volatility expansion would have led to particularly strong returns in those markets. So there could be a question there, was that a particularly favorable setup in those market sectors? And now that we're into a slightly higher vol regime, would it be less likely that we might see that persisting over time? I think certainly we'd all agree we wouldn't expect performance to be as strong as this year going forward. So in that sense, yes, there were exceptional things about this year. So I would say, yeah, from my perspective, big moves, very maybe unusually prolonged moves too. In some sectors like bonds, if you got a fairly simple kind of moving average cross signal at the start of the year, you would have stayed in that all year. We've also had higher interest rates this year, has been a small additional plus, and we've had that volatility expansion. So I think we've had, there's a number of dimensions to why it was so good this year beyond the obvious. So interested to get the perspectives from everybody else.
Yeah, Rob, what have you seen in your little machine?
Yeah, I mean, obviously it's been an interesting, as we've said, it's been a bad year for carry and a good year for trend. Although I think it's also important to emphasise that most of that action, at least for me, happened in the first few months of the year. The rest of the year, I've basically been treading water, and I'm actually down, I think, 4% since April. The other thing I found interesting, and I pointed this out in a podcast episode earlier in the year, was I've got a strategy called skew, which will be quite different from what other people, if they would call skew. But because all mine does is look at the recent skew of an asset, a future, and basically if that skew is unusually negative, it goes long, because basically the view is that the market's saying, well, this thing is horrible and unpleasant, and therefore will be cheaply priced, and therefore it's a good time to buy, and that works pretty well. But that's a classic kind of convergent strategy in a way. It should do badly when things like carry are doing badly, and it should be basically uncorrelated to momentum, and generally it is. But this year actually skewed it very well indeed. So I wonder whether there is something particularly unusual in the market this year, and I haven't really got a good explanation for it. But I think it's the only time in my entire backtest that I've seen those two strategies do incredibly strongly at the same time. So that may be an indication there is something weird about this year, whether it's because it's a rotation in environments, which you already touched on, or whether there's something really weird going on with the sort of relationship between price and volatility. I'm not completely sure, but it's definitely been a weird year for me at least.
Okay. Mark, is there any things you can point to as to why this year was such a strong year?
Well, I'm going to use a technical term. I'll call it the grind. I don't know if I could say this on a podcast, but let's go back to 2020. So March 2020, we had a tremendous decline in asset prices. It was a much bigger shock than what we've seen in 2022, and yet trend followers in general, some, if you were positioned correctly in February, you made money, but a lot of people lost money during that period of time. There was a huge move, but it was over a very short period of time. And so models didn't get a chance to adjust or respond to that shock. And so it never showed up in performance. 2022 has been slightly different because I call it, and why it was successful for trend followers is what I call the grind. We've just had markets grinding lower and higher, depending on which direction you're in, for a longer period of time. And this is one of the things that whenever you talk to clients, that always it comes up in some discussion. Is that I'll call it the Goldilocks environment. And the sense is that they'll say, like, they'll look at a chart and said, well, the market moved. Why didn't you make money if you're a trend follower? And it's like, well, the conditions weren't really that right. And then he's like, well, what do the conditions have to be? And it says, well, they got to move, but not too much. They got to move, but they got to have enough dispersion. And so if you look at 2022, in terms of the grind, we have the grind of central banks that, were sort of consistent with their policy change in the regime. You had the grind of inflation that it wasn't just a shock. It was just continue to move higher. You had the grind down, lower on growth. And so that combination of macro trends leading to price trends, really drives markets. And so the question you have to ask for 2023 is the grind going to continue? And that will determine whether you're really going to make money in trends in the next year.
Yeah, I will come to that. Jim, you want to say something about this?
Yeah, I think the grind to me means a secular trend, a secular force. I think that's what we're beginning to see. I think people are so used to thinking about cyclical moves within the last 40 years because it was a one-way secular trend with a bunch of cyclical changes. When you experience, imagine a graph where you're on the turn, you're in a regime shift, and all of a sudden the acceleration to a new trend is very fast at that first turn. It slows. The rate of change slows and kind of flattens out over time as that regime shifts. And I think we're on that turn, right? And so there's a real quick acceleration to trend, and that will slow over years. In my opinion, but that grind is that secular trend that is now starting, right? And I think that's very important to kind of think about. That's true for so many asset classes this year. You're really seeing a transition and a big push, a big force towards what people are seeing as a massive beginning of a secular trend. Again, we'll have cyclical moves between that, right? But that should be, secularly good, in the short term for trend, I would think. Again, it'll slow over time, but I think you're in a period where that turn is really fast towards a new regime, a secular kind of push, and that's really good for trend in the short term.
Yeah, I mean, I think from my point of view, I was thinking about this question, and there are kind of three things that I sort of seem to remember from the year. I completely agree with what has been said already, that I think that the trends unfolded a little bit slower, at least in some of the sectors like interest rates and currencies. So I think that was certainly beneficial up until the reversal, of course, in November. I also felt, and this is purely from memory, that correlations were a little bit different between some of the markets and sectors than what we've normally seen. For example, the bond equity correlation certainly was different. So I wonder if there are some benefit that we may have had from that. I can't really sort of articulate it better. And then to the point about, were there any particular time frames? I mean, I think Alan said it already that probably a lot of different time frames did well, but we actually in our firm we have a trend model that we run from time to time to see all the different time frames, pretty much from a few weeks up until a couple of years, to see which time frames would have worked the best had you known it. And it's very interesting because 2008 and 2014 has been the standout years where up until now every single time frame would have worked to varying degrees. But actually right now, I think at the end of October when we ran it last time, it's even stronger. It's even more pronounced that every single time frame in 2022 would have worked. So there is something a little bit unusual about the year, but I would say it's not that unusual. It's not like performance has been like 3 times more than it has been in a good year. It's kind of a good year, but I don't think it's exceptional in that sense. Now, someone mentioned that you can have the wrong kind of volatility. So as a segue, I want to jump to one of Jim's topics, because, of course, volatility strategies has been certainly, maybe you could say, performing differently to what a lot of people have expected, given what unfolded. And there are a couple of things, and I'd love to hear your expand on this, Jim, but there are a couple of things you said stood out for you in 2022. We already touched a little bit on this regime shift. We had inflation coming back, and then this equity vol and skew underperforming. And then you talk about this not being a coincidence, actually, and also in terms of options in previous secular inflation, or should I say the lack of options in previous secular inflation regime. So take this topic away, and then we'll weigh in as best we can.
Yeah. So 2 things I actually just spoke about, kind of the difference between secular and cyclical, and I think that's so critical to the way everybody should be thinking about everything that's happening in this market. We've had a secular trend for 40 years based on Federal Reserve activity and monetary policy dominance. That simple change, in my view, is changing this secular trend. Right. That's the core issue here, and so we're no longer just looking at the cyclical, we're looking at secular changes. And that's what regime shift is all about. And that makes things muddier. You have to look at 2 different things operating on 2 different timeframes and how they interact. It's a bit more complex. We happen to see this year some cyclical effects pushing the same way as secular at the same time in the vol space. On the cyclical side, people crowded in after a big vol move in 2020 and into long skew and long downside protection before a decline in the market, and that caused an oversupply of vol, over hedging, which on the way down has compressed volatility, compressed skew. And this is something we see cyclically that happens. We go one way on this, and then we go the other. Niels, you and I have talked about this quite some bit. It's really compressed implied volatility to the downside in the markets, and we've seen this kind of flattening of skew. So that's a cyclical effect. But at the same time, secularly, and I kind of referenced this briefly at the beginning of the show, we're secularly moving into a period of less Fed dominance, less monetary policy dominance, and higher inflation. And as that inflation creeps into markets, it puts a put underneath the market, and it actually historically over longer time frames kills skew. It removes the upside trend in markets and makes for a more 2-sided market. This is that that rise of carry conversation, right? We have over, if you look at the 60s to 70s, over 14 years, 68 to 82, the market went nowhere for 14 years. It had above trend economic growth. Earnings actually were quite strong over that period, more frequent recessions, but the market just died a slow death, right? In real terms, it lost 65% of its value, I believe, in real terms. So, I mean, you're looking at a market that is more likely, if we continue to have secular inflation, which I believe we will, that's likely to have two-sided volatility and not have upside trend. That's going to make the stock bond kind of relationship, break a bit, as it did during the 60s and 70s for a secular amount of time, in my opinion. But that secular trend should kill skew as well. So those two things have happened at the same time. The cyclical part, I would argue, is a bit overdone, right? And you're likely now people have moved completely out of skew and downside protection and are playing for that more secular trend. And it's a bit overdone. Everybody's on the other side of the boat now. And that's likely to cause kind of the second move phenomenon in the short term. But really secularly, that reduction in skew, that reduction in the downside, this carry trade dynamic with the fat tail and the upside bias is actually secularly on the way out anyway. So you kind of think about those two things together. This year has been, anybody who sold puts and sold stock this year, essentially, as a basic summary, or absolutely killed it. Right? That is the carry trade. That is the trade that and a lot of people, if you look throughout the portfolios and try and summarize what has, when things have done very well, it's basically that in summary in some form or another. That won't last, never lasts too long in the short term because of those cyclical effects, because of the crowding in, crowding out. But I do think it is a secular time where that general trade will do better over long timeframes.
Now, I want to bring in you, Alan, a little bit here to broaden out this particular topic a little bit, because as always happens, you end up with certain topics becoming quite popular, and I think this particular topic has become even more popular because during COVID there was a little bit of a Twitter spat between Universa and AQR, and now they're both coming out with papers, interestingly enough, on this trend versus tail hedge topic. So maybe we can broaden out the conversation a little bit to take that into account. And you promised me to summarize a little bit about some of their arguments, and then maybe we can all weigh in on that.
Sure. So there was two papers, one from Universa and then a second one from AQR. And as you say, both broadly on the topic of, our CTAs and trend following, a source of protection in portfolios, and how does that compare to kind of tail hedge strategies? So maybe just going through the Universa paper first, I suppose taking the summary is that I suppose the point that he says that CTA claims of being superior to other forms of risk mitigation are exaggerated. Now, some of the characterizations in the paper are maybe not things that we would agree with. So there's this suggestion that it is claimed that CTAs reliably achieve positive returns during major sell-off in stocks and bonds. I don't think we all will say reliably achieve. I mean, it's a more of a historical feature of CTA performance. A further claim is that trend following strategies have sufficiently large positive returns over the long run so that an allocation will add value. So I think we probably would say that. Some proponents go as far as to assert that trend following is an insurance policy that investors are paid to hold. So again, I don't think we would go as far as to say that. So in that sense, maybe we wouldn't disagree with the guys in Universa for what they're saying here. But at the same time, when you dig into this paper, there's probably kind of four main parts to it, really. First is really just a review of kind of CTA kind of performance historically, and I suppose there's an assertion here that maybe trend following returns have kind of declined over time. So the writer looks at the Barclays CTA index, the SocGen CTA index, and they actually include AQR's managed futures strategy in the paper. So that may be a reference to that spat that you alluded to, Niels. Their general first point is that CTA performance has declined over time. They look at the returns since the 1980s of the Barclays CTA index, obviously in absolute terms, you might question that because the volatility of the Barclays CTA index has adjusted over time, so you would have to adjust for that. One thing that they don't do was they don't adjust for interest rates. So obviously interest rates were much higher in the 1980s, so they haven't factored for that. But by their basic calculations, the return to volatility ratio appeared to be declining over time, and they were saying it would be a huge leap of faith to assign an allocation based on a high front-loaded historical return. So in other words, you shouldn't be allocating to CTAs because yes, they've done well historically, but most of those returns were back in the 1980s. But actually, I looked at the BTOP 50 index and looked at the 5-year rolling Sharpe, and it's at an all-time high now. That goes back to the 1990s. So that claim that CTA performance isn't as good as it was doesn't seem to stack up. The second thing is they look at kind of the CTAs in terms of equity protection, and I guess there is this general question here. I don't think we would portray CTAs as a protection strategy, but we always emphasize diversification. But even this CTAs as mitigators of equity risk. The general point here is twofold. One is that you shouldn't be just looking at Sharpe ratio, that you should be looking at the compound annual growth rate as the key measure, that if you combine trend and equity, are you enhancing the compound annual growth rate? And then the question is, well, how much would you need to allocate? And then the third thing is then, well, if you make that meaningful allocation, what about the periods when you have underperformance relative to equities? What's the drag? So the general point here is that when you look at it from that perspective, they kind of say it's been a bit of a wash in terms of growth rate, and the drag in the 2010s was so great that would be too great for investors to bear. And going forward, if you had a repeat of that, and that's the reason for not including CTAs. From my perspective, looking at how they present it, I think it's, if you look at the period, say from 2000 to 2022. Just looking like it actually combining CTAs does enhance the CAGR. The other point is they use the SocGen CTA index here, which is a low vol index. It only runs at about 8%. So if you use the SocGen trend index, which runs at 12 or 13%, you would see a much bigger impact. So you actually, I think if you run the numbers, you do enhance the compound annual growth rate, and you get a lower drawdown. So they very much downplay the drawdown benefit that you get from combining trend and equities. But there is this question that they leave outstanding of, can you still, would you be able to live with that drag that you've had in 2010, for having trend? The third part, then they kind of move into looking at bonds as another source of diversification or protection. And, they put up a chart here that shows the cumulative return on the SocGen CTA index versus the Barclays US Treasury index. And it's kind of remarkable because they say it's remarkable. I think it's remarkable in a different way, because the chart looks reasonably similar, but in no way kind of statistically assessed for similarity. And there are clear periods of divergence between the two lines. But yet to say it seems that CTAs have generated a significant portion of their profits from persistent long positions in fixed income, based purely on this chart. So I think that's quite remarkable in itself. Obviously CTAs did benefit from the trends in bonds at times, but they also reference a paper from Niederhofer and Wedderpohl, which I think we're probably all familiar with, which is ironic that they referenced that paper, because that paper at the time made the suggestion that CTAs might struggle in a rising yield environment, and we've obviously had that in 2022. And that hasn't been the case. So this bit about CTA's comparison with bonds seems to be, slightly unusual in the context of the overall paper. But the point is, CTAs seem to behave a bit like bonds, and they don't believe that bonds are a good protector. So. In conclusion, there are some kind of conciliatory remarks, I would say, in saying CTAs have performed very well in 2022. And that there may be a case, but basically you have to have a high allocation to move the needle, and then would you be able to sit with the drag that you had in the 2010? So if I was to summarize, that's it. But as I say, there's a few features within there, a few ways that they approach the analysis that are maybe a little bit questionable. And then maybe quickly on the AQR paper, it's fairly simple. It's just looking at trend versus systematic put buying and versus tail hedging funds. And basically the point is that, yes, in short, sharp drawdowns, the tail hedges will work better, but in more prolonged drawdowns, trend following will work better. And then the second point is if you take account of what they call the round trip. So if you think about, we had the sell-off in March 2020, but then you have the recovery after that. So when you account for that, the tail hedges look less attractive. And then there's the point about, well, if you take account of the returns in the period when equities are doing well, obviously your put buying is going to underperform. So over the whole cycle, adjusting for the two, trend following looks better than tail hedging or the tail hedge funds or systematic put buying. So that's kind of the other side of the argument, I would say.
Sure. Now, I want to get to you, Jim, at some point, because it's obviously sort of universes in your space, not our space. But Rob, you were itching to have a few things to weigh in on this.
Pretty much all the points I was going to make, Alan made already, because we obviously read the paper and had the same issues with the methodology. I mean, it's a pity, really, because in many ways the paper is correct in that if you do set up this straw man that trend following is this wonderful thing that does everything, and of course it doesn't. Of course you can argue with that, but the methodology in the paper is appalling. And that graph with a bond chart made me feel physically sick, frankly. But anyway, as he's done such a good job, I'll just add one thing, which is I think the AQR paper would have been nice if they'd added on both sort of slow and fast trend following, because obviously fast trend following is more similar to put buying in sort of its characteristics, and it probably would have done better in these shorter, sharper drawdowns, while also paying more over time as an insurance premium. So that was the only thing I'd add. I think the AQR paper is much better, and not just because it thinks trend following is great. I think it's just a much better written paper, but that's the only thing I'd add to it.
Yeah. Mark, before we get to Jim, any thoughts on your side?
Well, I think the important point is the difference between allocation diversification and strategy diversification. And I think especially with that particular paper, they talked about, well, if you held bonds, you'd have done pretty well. And when you tie this back to our idea of the age of carry, is that bonds were a great diversifier. Is that interest rates are coming down. You had negative correlation with stocks. This is a great way to protect your portfolio. If we're having a secular change, if we're entering a new era, then you have to think beyond allocation diversification, because that really works well in a carry environment versus strategy diversification. And I think that we're into the new age of strategy diversification because, bonds aren't going to give you the diversification you thought because correlations are now positive with equities. So you have to think about what is the environment and what is the strategy or allocation given the secular environment you're in.
Now, in terms of strategy diversification, I think that's actually a good segue over to you, Jim, because a lot of people talked about volatility strategies, and I think they implicitly just thought about long volatility. But at your firm, you obviously do different things and have had a very different, much better year than most of the volatility space. So, but also, I guess maybe the people at Universa, not necessarily personally, but of them, because I seem to remember they kept coming on my radar, and maybe this was part of this Twitter spat with Cliff Asness. Because they claimed this 4,000% return during COVID, but it turned out that they were calculating this based on the premium they put up as margin or whatever it was. So it wasn't really that comparable. Anyways, I don't want to put too many words in your mouth, Jim. Tell us what you're thinking.
Yeah, before I dive into the tail part, I just want to reference the trend piece real quick. As I mentioned, I think it's very interesting, the Universa, when it looks the paper, when it looks at the data, it starts in 1980. It's funny how many, how much data analysis when people want to support what's happening happened last, takes that 40-year period specifically, right? Yes, there's been a cyclical kind of effect, secular effect during that period, but we are transitioning out of that now. And so I think just looking at that data set is a big problem for lots of investors. So anytime you see something start 80, 82, 84, purposely cut there, treat that with some caution. In particular that, for over 40 years, we had a decline, in my opinion, a secular decline in the effectiveness of some of these trends because the risk premium got compressed, and that trend itself has started to die recently. We're having an acceleration of a new trend. So that new acceleration, as I talked about, is a positive in the beginning of a new opportunity, in my view. So I think looking at that, I'm actually a big proponent. I'm actually, boosting this kind of idea that I think trend could be very good for a little bit here. And we could be at the beginning of a new cycle. On top of that, risk premia has gotten so compressed, we're moving into a regime where risk premia itself should increase. And that should help CTAs and others of the like as well. So that's kind of a secondary effect that I think is very important that people don't. There's a difference between what's actually going to happen to realize volatility, and now we can kind of transition to volatility, and what's going to happen to implied volatility. I actually think that spread between implied realized is secularly going to increase, and that's a good thing for people in the vol space. It creates more opportunity, and that risk premium is not just at the money; it's on the tail, on other places, realized relative to implied. Now that doesn't mean skews going higher or demand necessarily higher. It's just that spread itself between realized and implied should increase over time, and that's just because there's less liquidity. There's less money to go around, so there's less ability to absorb liquidity, and that in the short term should create some opportunities and more risk, pricing in of risk premia as a result. So yes, in volatility broadly, I think we're entering a period where the market is, again, as we talked about, changing. That demand for downside protection will continue to be strong, particularly in a market that's going to be much more two-sided and is not just secularly trending. You're going to have more. If we look at the 60s and 70s, you had 4 major recessions in about a decade, just over a decade long, like a 13-year period. Very frequent crises, much more quick problems, but over time, the amount of volatility, was much lower over the long term. So we did some data, and we've talked about this data analysis. We've talked about this recently, but 5-year vol is actually about 10% lower on a realized basis during that 60s and 70s period than over what we've had. And the majority of that difference comes from upside. There's just less upside vol. There's more mean reversion to these markets over longer periods of time. And that means actually, ironically, that these periods on a nominal basis, now we're looking at nominal assets, that's important to note, is actually a good opportunity, right? Because you have these first order effects, which are making assets cheaper and cheaper over time, right? But you have these second order effects where there's less risk, there's less money going around, less demand for stocks, and all while risk premium itself is increasing, right? So now imagine you have this longer term period where there's more mean reversions. Markets over long periods of time don't really go much of anywhere in nominal terms. In real terms, they decline. And those nominal assets then also over that period have higher risk premia. So I think over longer time frames, we're actually entering and that doesn't mean right now, but over longer time frames, you're entering a period where there's less competition for that risk premia. There's less leverage. So there's more opportunities actually to include kind of risk premia harvesting strategies. Now, to be clear, there's a tail on that, right? And we have a long vol strategy. It's done, as you mentioned, well over a considerable period of time. And so that's very different. I'm talking about 5-year outcomes, right? Now let's talk about that cyclical, right? In that cyclical window, though, we're just at the beginning of this turn. And we've had a period of dramatic underperformance of that vol. So I think you're likely within that to have more opportunities to dynamically, if you're very dynamic and you're active in your hedging, to come in and really profit more frequently from short-term opportunities. And that's what we see again in the data, more frequent problems in the market, more kind of sharp turns, but more mean reversion, and ultimately a lack of equity performance over the long run. And I think that's probably the most likely outcome. So I think you need to be active with your hedges. I think equities versus puts versus equities is just not going to work. It actually has worked okay because of the upside trend and the performance of equities and the geometric returns that's provided as part of a long investment strategy. I think that won't work very well. I think that risk premium you'll have to pay for it without that upside trend performance in equities. So I think actually, ironically, over kind of this next 5 to 10 years, I think more put writing strategies will do significantly well on a longer time frame. But again, short term, tail is important. And again, the way Universa does it is probably the worst way to do it. I think Universa is going to have a tough hoe. They just go and buy little puts again and again and again. And I think that world of rally, and then big blow up, rally, big blow up is probably not what we're seeing, going to see for the next 5 to 10 years. And so the benefits of those kind of big blowups in the context of a longer equity portfolio, is going to be a tough argument looking back in 10 years.
All right, I'm going to jump to one of Mark's topics, and it kind of is very topical for a conversation like this, and that is, what did we all learn from events in 2022? So Mark, maybe I can start with you. What did you learn from events in 2022?
Well, especially at the end of the year, you always want to sort of do the self-reflection, and the conclusion I came to is that I don't really know that much, and that's why sometimes I should be a trend follower or use that as a basis for trades. So the perfect example would be is that if you started 2022, we were near zero interest rates. By when they started raising rates, and let's go a year forward, we're going to have Fed funds rates up about 500 basis points. And so if someone said, do you think, what's the over and under of 500 basis point increase in Fed funds, I probably should have said, that's a little crazy. So I think that the humility that you always need at the end of the year is important. And what you figure out is that your forecasts a year out will be extremely poor. And so consequently, that's why we start with our priors of just following the trends, because the trends can last longer than expected. There could be situations that you don't even anticipate what could happen. Another sort of big surprise was we had the big spike in commodities at the beginning of the Ukraine-Russia war. By March, a lot of commodities spiked, and you look at energy prices, you look at wheat prices, some of the grains, they were moving in the opposite direction. So again, that's something where you sort of said, well, did that surprise me? Yeah, so I was sort of expecting that commodities were going to have a significant or further run up, and in reality, they mean reverted. So I think that you're constantly surprised. You find out how much you don't know. And without sounding sort of trite, that's the reason why you follow the price action, because your long-term trends based on exogenous variables, macro variables, could be poor. That being said, I always take the view is that macro trends drive price trends. So in some sense, you need to have an idea what the macro environment is doing, but you should always start with the price action first as your basis for any forecast.
Sure. Alan, what did you learn, if anything, in 2022?
Yeah, I mean, I think similar to Mark, humility, open-mindedness. I think probably things can happen a lot more quickly. It's like that thing. I can't remember what the exact expression is. Things are the way they are for a long time, and then they change very quickly, or whatever it is. But it was going back. I mean, I think a lot of us expected, making the case for trend following managed future strategies, expected that there would be a good opportunity at some point with low yields, elevated equity valuations, etc. But that it all kind of happened nearly in the space of 1 year, or that we had a big adjustment in the space of 1 year was probably a surprise to me, and that we had that, obviously, and also probably that people adjust to a new regime so quickly. If you'd said to somebody a year ago inflation would be 10%, people would have said you were mad. Like, it wasn't on the radar at all. I remember people forecasting 5 as an outlier event, but now we're into a new regime, and we deal with it. So, we've always, I've always felt, literally anything can happen in markets. You have to be very open-minded, but when you do shift to a new regime, the markets do adjust to that, I would say being open-minded, humble, and anything can happen.
I would go back and I was just going to say that the quote that I think you're referring to is by Rudy Dornbush. It said, in economics, things take longer to happen than you think they will. Then they happen faster than they thought they could.
That's exactly it. Thanks, Mark.
And that sort of is, why you're a trend follower in a nutshell.
What about you, Rob? What's your takeaway from 2022?
Yeah, exactly the same. I've long been resigned to my inability to make predictions that are successful. I did make one successful financial decision late last year, which was fixing my mortgage for 5 years at like 1.2%. And so if I tell everyone that I meet about this, so they come away with the pressure that I'm some kind of financial genius without telling them that secretly, the vast majority of my financial decision making is made by, frankly, trivially simple rules, and just leave it at that.
Mm. And yourself, Jim, what's...
The thing with prediction is everybody thinks in 2 dimensions. Most of the wealth management space thinks, is the market going up or down? Is this thing going this way or that way? And I think that's a fairly hard, almost impossible task. But prediction of distribution is a lot easier. Prediction of understanding environment and the forces acting upon the structure are in this shape. And I think that you started the conversation today about referencing the rise of carry. The rise of carry doesn't speak to direction; it speaks to shape of the distribution, right? And you can understand these forces and begin to make pretty accurate assumptions about how that shape looks of the distribution, and that itself can be incredibly profitable. And really, secularly can improve your returns across strategies if you can get that part right. And I think that's what we're talking about here. So what does the shape look like? What are the forces acting upon the environment? And so I think this year kind of emphasized that, right? Being open to not just following some data, but thinking about what are the forces acting upon the shape. And there's a lot of major things happening here, right? I think the biggest of all is very, very a very, very long, deep, important thing, which is, demographic change, a change in not just the amount of millennials coming into consumption, but the underperformance of those people and that inequality, right? And that is driving a demand push economy and a move from record Gini coefficients back down across the market. And I think that simple singular force is acting upon the distribution in very meaningful ways. It's going to increase, it's going to force a normalization, right? A mean reversion to a much longer trend and a normalization. And that changes a lot of things, a lot of shape. And I think if we're open to those things and understand that, then we can start to profit on different parts of that distribution accordingly.
We probably all agree it is very hard to be predictive, but that does not mean that trend following is non-predictive. So oftentimes people sort of say that trend following, oh, you don't have any view of the future, you're non-predictive. That's not true, or at least I don't think it's true. This is that the fact that I could say I have a hard time forecasting doesn't mean, and I say therefore I'm going to place more emphasis on prices, does not mean that trend following is non-predictive. So there's a separation between the two. And I think that Jim made a good point is that we may not be very good about knowing the direction of markets, but we do have sort of good ideas of what may happen if we're in a certain regime. We do know conditionally what might happen if we're in certain environments. And so I always sort of talk about there's a difference. The first thing you need to do if you want to be a predictor is say, where am I first? Then I could sort of say, where am I going? So it's almost like the driver who's saying this is that who doesn't look at the map is that. So first you have to say, what is the regime that I'm in? Okay, given this regime, here's the likelihood of what might happen. I cannot predict for sure what will happen, but I know that I have a little bit of an edge of the likelihood, given I know what the regime or what the conditional environment may be.
Cool. All right. Yeah, I don't think I can add much to that, except just to say that the way I've always thought about this is just that we just have to be open to imagine the unimaginable. I think this is the reminder that I always get from a year like this. And unfortunately, it's a little bit like, I think I've seen some of these. I think it's Sir Ken Robinson, who was this most viewed on TED Talks about education, where he talks about how we are removing their creativity in education. And I think what we in the financial world has been slowly removing in the past 2 decades is just our imagination that markets can move, in crazy ways, like negative oil prices, just because we've had a couple of decades where everything has been pretty much under control. But I think that's, coming to an end. Anyway, let's move to something completely off base here. And this came from Rob, of course. Rob only gave me like 2 words in terms of a topic. So I definitely need a little bit of context here from you, Rob. But the 2 words you gave for this conversation was crypto and FTX. So please set the scene, Rob.
Well, the scene is that after many years of having crypto people tell me I'm an idiot and don't know what's going on and all of this stuff, that finally it looks like the kind of sheen is coming off the market, as we've had this huge FTX scandal that, of course, was on the back of a scandal earlier on in the year, and the just general deflation of prices. Now, this is not a podcast where I think we should sit around and pontificate about what the price of Bitcoin should be in a year, because of, as we just discussed, right, prediction's futile. I trade Bitcoin futures, and I don't think I have a position on it at the moment, but obviously if the trend goes one way or the other, then I'll buy or sell it. I'm completely indifferent about that. But crypto is effectively an asset class. And we talk about asset classes, and some people have said in the past that, for example, that crypto is a tail hedge. I'm hoping that argument is kind of looking a bit silly now, but people have said it. So I think it's maybe worth spending just a few minutes sort of not trying to predict, but sort of saying where do we feel crypto is in terms of its life cycle? Is this it now, or is it just going to disappear and just become again the chosen medium of drug dealers and money launderers, or is it going to dip down and then sort of climb up again and become something respectable and useful in the future? I'm up front. I'm a skeptic. I've always been a skeptic. So I'm probably of the former argument that it's going to just be one of those fads that will look back in 100 years' time and like the South Sea bubble, and people will write books about it, and people will say, "Oh, isn't it hilarious that people used to spend the price of houses on a tulip bulb? Replace that with Bitcoin, and you've got the same story." So that's where I am. But I'm obviously, I'd like to hear what you guys think, because you may have different opinions.
Sure. I'd love to hear what Jem has to say about this, because I don't think I've ever heard your opinion about crypto, actually. So
we had a couple conversations in there. Look, I've been pretty clear that crypto is a speculative bubble, right? That said, blockchain itself is a secularly important thing. I think, personally, I think it's going to, Web3 is going to change the world we live in. So in many ways, it's not too different than the tech bubble of the late 90s in some ways, right? People got way out in front of it. I also think the money was misplaced. I don't think crypto, as a currency, I think it's dead money, right? But if the argument is that money that is flowing into these is then being used for Web3 kind of blockchain focused projects, different story, right? And those are 2 very different things. And I think people often get those 2 things confused. despite it being a speculative bubble, I think it's important to note it is the religion of, we've talked about this, Niels, but of this millennial generation on down. And we're all sitting here 45, 40-ish plus, well, I won't name any years here, but, talking about something that really belongs to a younger generation for the most part. The reason crypto came about, in my opinion, is three major things. One, this generation grew up for 40 years during a period of technological innovation, money flowing into corporations, forcing more and more technological advancements. So they believe technology can cure all our problems. Most importantly, two, these people, this generation, didn't benefit from the wealth creation. So they were the ones on the bottom of this inequality distribution. So this idea of fairness and justice, that's all we hear about, right? Equality, equity, justice. During these periods of inequality, these are important things to this generation. And so they feel the system isn't fair. The idea is burn it down, break it, take the money, the power away from government. That was the other driving force. And lastly, because they underperformed, they wanted to catch back up. They needed to catch back up. They're reaching primary household formation years, and they're at 40% of where the baby boomers were. So let's YOLO calls and let's bet on crypto. Let's go for speculation and find a way to make money. It is the religion of this generation. It expresses a lot of the things they grew up with. So they're not going to let go of it. And they are now just growing to these important investment years of their lives. So I do think that there is, just because of that, some underpinning level and value to these, just because of the generation that's coming to economic and political dominance. That said, I do think its uses and its the speculation and where it's kind of the money's been pushed is incorrect. And I think that pivot to more blockchain, Web3, et cetera, over times will ultimately bear out. So that's my broad view. But speculative bubble in its current context, much like the 2000 tech bubble.
Alan, what's the Irish view on FTX and crypto?
Hard to generalize, but I'd agree with what the guys have said. It's behaved like a speculative asset in the sense that, as the rates have gone up and liquidity has come out of the system. You've seen it in Bitcoin probably did peak before the S&P, but it's pretty much traded like a risk asset. So it's kind of at the high beta end of the spectrum. As Rob alluded to, we did see people circulating charts, saying if you added 1% of Bitcoin to your portfolio, it would improve the Sharp and all of that. And you had to claim that it would be an inflation hedge or that it was, digital gold, and all of those have been proved to be incorrect. And you had the typical bull market kind of qualitative measures too. Definitely this time last year, I heard of at least two people who were setting up crypto trading funds here in Dublin, and people were approaching me, and as somebody said to me, there is money to be made for everybody here. That was literally the comment. So these are all of the things that you hear at the peak. It's kind of, I'm a little bit surprised it's held in a fairly okay in the last few weeks, but I guess it's been a favorable few weeks for risk assets. I would tend to agree. Tokenization, all of that does have the potential to be very, very interesting. So that if we take the kind of the 2000 boom bust as a template, technologies that were transformational did come out of it. So I'm certainly open to that possibility. But in terms of tokens, I haven't been a believer, and I would guess if we saw another wave for risk assets that they would come under pressure in that type of scenario again.
I'm sure, Alan, that the guy who said to you there's money to be made for everyone, he was thinking about all the service providers to the fund, not the investors. Anyways, Mark, your thoughts quick on crypto?
There are
FTX?
three things that I think are important from this. One is that, and some have alluded to this, you have the bubble riders in the age of carry or high leverage. In a sense, as a lot of people said, in a ability to borrow money cheaply, you want to try, or people said a strategy, and it's not just for crypto, is that I ride bubbles. I find a bubble and I sort of ride it as much as I can because I can borrow money cheaply. I lever as much as I can, and that's the way I can create wealth. that is coming to an end because the cost of leverage and your ability to borrow is going to be diminished. So you're going to have to, make money the old-fashioned way. You're going to have to earn it, as they said from the 80s. The second is that Charles Kindleberger talked about the Kindleberger cycle, and with that he said is that you can have bubbles, but that can actually have social value if it's for a technology that pushes investment capital into new technology. It could then rise to a bubble, but then after the bubble bursts, the technology still exists, and that might have a social value for the overall economy. That may occur with crypto. We're going to wait and see on that. That still might be out. So we could sort of say you had bubbles in railroads in the 1800s where, the bubble burst, and then we were left with a lot of railroads that, sort of had a big boost in productivity. The third thing is that when you tie crypto at FTX is that we have to sort of realize is that structures matter, regulation matters, and trust matters. And in particular, let's take it a more future example. The whole LME debacle with nickel. If the underlying structure of markets is put at risk, or the trust in markets is put at risk, then that causes trading and to grind to a halt. And then people can't be able to allocate risk appropriately because the structure doesn't exist to do it. That's what you're having in FTX. And we'll sort of say regulation matters because it's sort of say you look at some of the things that are going on here. Is that you just sort of say that, as I've mentioned before, as John Kenneth Galbraith talked about the bezel, this is that there was wealth created for those who did this. And then there's the assumption that that other people had wealth. And now as the bubble bursts, then we find out that, money was taken from one group to another. So I think the final thing is that even for trend followers, we care about regulation and structure, because if we don't have the right regulation and structure, we can't be able to do our job.
Yeah, no, absolutely. I don't have much to add other than to say that I actually hope parts of it survives, but certainly not in the form that it is today. And most importantly, I really hope that a lot of the bad actors that I think we all know who they are, and including some of the financial platforms or media platforms that have been pumping and dumping, this space, will disappear, frankly. Anyways, we'll see. All right, I'm going to end our conversation for this week on that note. This is part one of our 2022 holiday season special group conversation. We hope that you've enjoyed it. If you did, please head over to iTunes and leave a rating and review so that more people can discover the podcast and follow the podcast. And next week, we'll be back with part two of this special group conversation. So make sure you go and check it out when it's out. In the meantime, we wish you all the best for the holidays. From Jim, Rob, Mark, Alan, and me, thanks so much for listening. We look forward to being back with you next week. And until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.